For the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, everybody, welcome back to the Saturday Sendout from the Simple Side. We have a super interesting article today. So if you're listening on YouTube or Spotify or Apple Music, jump over and look at the article because we've got some great graphics for you, and I'll see you in 2 seconds.
Welcome to the Simple Side. Market beating picks inside. There's no jargon and no time to waste. Join the Simple Side and end up in first place.
As always, I've got those quick reminders for you. Our full disclosure is in our email footer, which you can find again at thesimpleside.substack.com. You can get all of our daily news updates by going to thesimplesidedaily.substack.com. And you can see our stock research reports by going to thesimpleside.news. Now, I know that's a lot of links, but if you go and read the newsletter, you can see all those links listed at the very top of every single newsletter that we send out on the weekends. Again, thesimpleside.substack.com, and you'll be able to find all of those links listed in one of our emails. All right, Simple Side shareholders. Last week, I told you that I had a few things planned for 2026 that were all being developed right now, and that was kind of taking up a majority of my time, which is why a lot of my newsletters have been short or quick or slow to come. And so I just wanted to share one of those things we've been developing with you now, and that is macro forecasting, which we're going to end up calling the Simple Side Indicator, or TSSI. And it's something that I've been building behind the scenes. And so if you're reading the newsletter, you can see a graphic of what the indicator looks like. And so what it is not is something that's highlighting where the peaks and troughs are of the S&P 500 over the past, 10 years, 15 years. What it is doing is it's showing you our back-tested, I guess, quote unquote math. I don't know what you would want to call it. Basically our back-tested rankings of when should be a time to buy, sell, hold in the stock market. And of course, that's running from 2010 to 2025. That's the image that you're looking at. And you'll notice that the model does a fairly good job of providing a risk assessment for anyone that's in the markets. You'll notice a few places that I have marked on our chart above where the model was yelling sell and the market proceeded to go upwards. But in general, you'll see a deep red sell indication. It's time to sell out of the market, at least until we see that buy indication come back up. And of course, the same is true in the other direction. Wherever you see a dark green is typically the best time to buy in the market. And you'll see, after a dark green, the market will typically run up over the next few months or even over the next year or so until we get to another deep red spot. This model is going to be shared with all paying subscribers in 2026, and we'll be making weekly appearances in the newsletter alongside our market commentary, portfolio updates, and everything else that we share. Again, I'm going to be uploading all of this to thesimpleside.news as well, which is our website where we kind of do our research tracking and some other things. And I'll be adding our portfolios and things like that on there sometime soon. So just be on the lookout and be ready to go and check all that stuff out. This week, typically do our market commentary or a weekly roundup, and we'll talk about everything that happened in the markets over the past week, and we'll kind of get into how that's affecting things, what we're seeing in general, how we think that's going to affect the market in the coming months. But this time I'm going to do something a little bit different. I'm not going to focus on the news at all. I'm going to talk about this indicator that we've been building, this macro forecasting indicator, and just give you kind of a first look at TSSI, again, the Simple Side Indicator for 2025, and kind of show you how the data feels about the market. So go and look at this graphic again in the newsletter. I'm going to have this probably be the thumbnail image for this. So if you're watching on YouTube, if you're actually watching that video, or if that video is on your phone, you'll be able to see this big red circle that I have for 2025. And what you're looking at is the indicator saying that for the majority of 2025, we've been sitting in a very overvalued range. You'll notice that in the red circle that I put on this chart, you're seeing a large majority of that color of that graph being red, a darker red, and a yellow. So it's kind of saying it's wavering between a hold and a sell period across the board. So, just keep that in mind. But this is basically the reason why I've been 50% in equities and 50% in cash for the majority of 2025. Actually, really the entire year of 2025. And really, when I say cash, I'm talking about accounts yielding 3.25% or 3.5% interest. So we're not making $0. We're not losing money to inflation. We're still growing that cash pile. It's just called cash because it's in something so extremely safe that, it's not going anywhere. In general, I feel like that's the correct position to be in given the current state of the market. And what is that current state? Well, it's emotions. Emotions are driving a lot of what's happening. News, investor sentiment, all that stuff is kind of driving the market right now, which is why you'll see a lot of big dips showing up randomly, which isn't typically the case. Usually it's kind of a slower slog upwards and the dips aren't very large. But in this case, in 2025, you're seeing a lot of large dips happening here and there. Some of that's from, tariff news or what have you, which could turn fundamental, but a lot of it's all emotional trading by investors, most likely because people are afraid that the market is overvalued and they don't want to be, quote unquote, caught with their pants down when the market does take their big drop. Now, while you're looking at that graph, something I do want to make note of is that in 2025, the simple side indicator hasn't actually hit a strong sell alert yet in 2025. So in the beginning of 2025, in January, February, we saw some buy signals. And then in March, April, and May, when the market really started to drop, we saw basically 3 months of buy indication from the indicator. Then we saw a hold kind of halfway through May into June. And then as soon as we got into July, we started to see that sell indicator start to kind of ring, but never a strong sell. So in general, our indicators saying the market's overvalued, although it has switched kind of to a hold status, meaning, no alarm bells are ringing. It's just kind of saying, hold on and wait. So that's kind of where we're at now. We're not selling out heavily, although leading into 2026, if the indicator kind of remains in this hold territory or kind of switches back to a sell, we're going to be selling down some positions, and we'll probably end up with more than 50% cash. So that's where we're at right now. I will say that the thing that has probably switched us from a sell or a risk off regime into a hold or a moderate risk on regime is the momentum that we had in the market. So from July to November, we've basically been on a straight line up in the S&P 500. And so that momentum that's been created over that period of time is basically telling the indicator, hey, things are trending upwards. We should, appreciate that trend upwards and look at buying. And so that's why we're seeing the hold show up in November and December. However, that momentum has died. So November to December, the market has basically leveled off. We haven't really seen growth in that period. And so what you're looking at is, if you smooth out the model, which is how this works. So, we're kind of taking a simple moving average over the past X period of time to make this indicator work. That's basically all jargon, which I try to stay away from. But basically what it's saying is that the momentum is slowing, and I would expect to see sell or strong sell indicators coming up in early 2026. Of course, the data could change, and it could say go risk on and start buying, and we'll follow that if it says so. But for now, it's looking like relatively risk off territory. Now, one of the things that we account for in this model is the Fed funds rate. So whatever interest rate the Federal Reserve is setting, we take that into account in the model. And what that means is that if the Fed does cut rates, if we see Powell leaving and we see somebody come in who kind of does Trump's bidding, if you will, and starts to cut a ton of rates, well, the model will take that into account and it'll adjust risk on, risk off based on all that happening. And so, we won't feel like the model is going to be inaccurate if we start to get tons of rate cuts here in the next little bit. It'll probably say risk on, and we'll go risk on at that point in time. Needless to say, where we're at now We're building cash reserves. We're preparing to go risk off for 2026. Now that risk off doesn't mean 0% equities. It just means less of a percent and more percent in the bond commodity side of things. And in general, we're happy with that. So we have no problems being very risk off going into 2026. I know that's kind of different than our typical market commentary, but I think it's really important that we have something that's mathematically driven, that's statistic driven, that's saying, based on what we've seen in the past, this is where we see the future going. And of course, this model is always going to be learning. And so it'll constantly be getting better. And anyway, that will be shared with all paying subscribers soon. They'll have access to that on the website and all that good stuff. Now we're going to talk about portfolio information, which of course you can go and copy trade our portfolios on autopilot, which are links to go do so in the newsletter. Again, thesimpleside.substack.com, and you'll find the links in there. So go copy trade us on autopilot. We put all of our portfolios on autopilot in July. And before that, we had everything on a company called Double Finance, which has closed down. But since July, the market's returned about 7% to investors, which makes up about half of the year-to-date returns, which is 16% for the S&P 500. Now that's great for the S&P 500 compared to the 10 to 12% it averages. 16% is great. Really, it's really, really well. But on autopilot, our portfolios have returned 1.58%, so a pretty sizable underperformance there. But then we have a 14.12% return and a 12.01% return. Again, all these are since July 2025. So we've got two portfolios that have basically doubled the SPY in terms of returns since July. But if you were to be following our portfolios from the beginning of the year until now, you would likely be sitting at 36.16% returns in our flagship fund and 57.76% returns in our AI secondhand effects portfolio. So still very sizable outperformance if you look at the year overall for our portfolios. Again, we're going to be rebalancing all of this stuff come January 2026, although we are going to do a bit of a rebalance on our tech growth portfolio now. So if you're a paying subscriber, jump over to the newsletter and you want to go look at all those changes that have happened. But in general, 2026 we'll be rebalancing, and we'll probably end up rebalancing into a larger cash position as well, depending on what the TSSI, the simple side indicator, looks like. So all that being said, guys, paying subscribers, go read into what we're doing with the portfolios, because we are making adjustments coming into next week for one of the portfolios in a big way. And other than that, I will be seeing you next week. I will have some research reports coming out again. We'll start sending those out. And then, of course, I'll be sending out stock picks for the 2026 year as well soon. So be on the lookout for all that stuff, guys, and I will see you next week.